American dream of a house in the suburbs, a family, a little leisure, and lots of stability, all in the exchange for a little hard work, didn't always exist. Home ownership wasn't considered an essential part of growing up, or even being American, until much, much more recently. Investments like radios, automobiles, appliances, and even fur coats were far more vital and desirable just a century ago, when the majority of people rented. Owning a house was understandably expensive, but it is today as well. There just wasn't the same system built up to help. It took our society changing its opinion about renting and a number of economic disasters to formulate what we have today. And it's quickly growing out of date. So just how did we make buying the American dream home an option? And what does that mean for today's housing crisis? The term American dream as we know it only dates to 1931, when James Truslow Adams used it to refer to the structure of the American mind, not a real state, but an idealized one. A dream where anyone could accomplish their needs and a few wants with just some basic effort. We didn't have a centuries-old system of aristocracy holding the average person down. It was a dream of possibility, of opportunity. It didn't just pop out of nowhere, though. The trust, the belief, the ability to dream had to be built, and so did the American home. In the 1800s, it was more typical for people to rent than buy. But by the turn of the century, there were growing discussions about the social impact of owning a home, often referring to the decadence of home ownership. One lengthy article begins, "A man without a home is a creature robbed of manhood. He is prey of any evil influences which may choose to sway him. But the man who has been reared under the sacred influences of a happy home will ever be surrounded by those pure sentiments and attachments that make his native land a venerated ideal, and in his home will flourish and multiply the sentiments of patriotism and morality, which are true foundations upon which rest the stability of government and civil society." A lot of words to say, owning a home is important to people feeling happy. Interestingly, this article from 1895 considered any mortgaged home as much of a problem as a rented one, citing that the 1890 census showed, in very rough math, around 16% owned their homes outright, while 18% had mortgages. The rest were tenants. These numbers were troubling. In his mind and many others, owning a home encouraged people to care not just for the building itself, but for their family, community, and nation. Granted, today we know caring for your home doesn't only happen when you own it. That's why I'm so happy that the sponsor for today's video is Blueland. So I'm about to move into a new, old house, and I'm looking for household products that are friendly to my house, myself, and the planet. Blueland has built an entire range of household cleaners on that concept. They have no single-use plastic, even the refill packaging is compostable, so you get super convenient little tablets instead of throwing away a whole bottle every time. And they have these adorable metal containers that come with their starter kits. Seriously, look at how cute these are. Blueland uses naturally derived ingredients and no phosphates, chlorine bleach, ammonia, or phthalates. And they have fragrance-free options, which I know you guys appreciate. Best part is they're super affordable and work. I got the tablets for the dishwasher and the laundry, which are so incredibly easy to use. For the dishwasher, just drop it into the dispenser, and the laundry, it just goes into the drum with the clothes. So much less mess and no giant plastic containers to deal with at the end. They've got lots of other options too, from hand soap to glass cleaner. I can't wait to try out their entire range on my new house. Honestly, my favorite thing might be that you can set up a subscription, because I am always forgetting that I need refills until it's too late. So if you're looking for household products that are eco-friendly, budget-friendly, and decor-friendly, check out Blueland. All you have to do is click the link below to get 15% off your first kit. Blueland is sharing this special offer just for my viewers. Thanks again to Blueland for sponsoring today's video. It's not surprising how much our 1895 author hates the idea of mortgages. Go back a couple of centuries and there were still arguments over whether it was the borrower or the lender that had possession of the property until it was paid off. The mortgages weren't paid back in set amounts either, but were simply due in full by a certain date. Not a system set up to help the average person succeed. And while most of the ownership argument had been settled by the 1890s, borrowers still paid back mortgages in only a few short years with increasing payments and variable interest rates, often with one large payment due at the end. 5 to 10 years was the typical range, but even 3 years wasn't uncommon. Could you imagine saving up enough to pay off an entire mortgage in 3 years? If the buyer didn't have at least half of the cost of a down payment available, they usually did multiple mortgages or used a building and loan association mortgage. Think of it like a co-op bank funded by the members. Amortization, paying both interest and principal back as you go, was usually not an option. There were often even fees for paying more than the interest. Many borrowers, desperate to not lose their home as the final giant payment came due, would simply refinance to start the loan over on the principal. Dramatically different from today. In fact, a small down payment and regular monthly bills, like many of our modern mortgages, was considered an installment plan at the time, and was not highly recommended because house value wasn't always rising rapidly. But the use of mortgages and renting was rising at the end of the 19th century in the US. To sum it up, the article ends saying, "This startling diminution of the number of free homeowners is an indication that points to a dark future for our country, unless something is to be done to stay the tide of landlordism and curb the greed of speculation that like an octopus has wound its deadly tentacles about the American home." Granted, the author also thought that people chose to be tenants, and that anyone could accomplish home ownership if they just tried a little harder. A lot of doom and gloom without actual solutions. Not that other people weren't offering them. Another article, supposedly written by an Iowa miner, laid the problem at the feet of the landlords and the government that enabled them. He suggested exempting homes from taxation and establishing an anti-usury rent law, essentially tying rent limits to property value, in order to reduce the financial temptation to investors. The mortgage system was just one tiny bit of how different the entire process of buying a home was back then. In 1903, Ladies' Home Journal published a series of articles looking at how different families paid for their house. While nearly all used mortgages for at least some part of the process, either the plot of land to build on or the construction itself, most of the stories focused on what they gave up to save money to pay things back slowly, foregoing extras like ice cream sodas, country drives, and magazines. According to one couple, a few saved money by building the house themselves, while others relied on a neighborhood building association to pay for building the house in their zoned area and used a loan to pay them back. Notably, all of the loans mentioned fall within a 3 to 10 year payment system, and almost all of them are building a new house. Considering that most older homes didn't have plumbing or electricity built in, that was understandably the less preferred option. There's a reason why build-it-yourself home kits were so popular throughout the first half of the 20th century. It was common for people to mortgage a piece of property for a few years and then build their house, whether it came from a contractor or a catalog. Rising costs of construction materials would push buyers back towards existing structures, however, and finding a decent new-ish home in the suburbs, even in the early 1900s, took time and effort. Thus, realty as an industry in the US started up at the beginning of the 20th century. In 1908, they established a National Association of Real Estate Exchanges, bringing together brokers and agents. It was still a pretty sketchy business, however, since there weren't regulations on who could claim to be a broker until later. Not surprisingly, open houses of both new builds and old started up around the 19-teens as well. The house sales market we know was forming quickly, and with it came the early murmurs of the American dream. In 1917, Indianapolis ran a Buy a Home campaign, and they were not the only city around that time to do so. The logic was that owning a home gives the husband self-esteem and the wife social dignity, a place within their community. It's also a good financial investment and supports the local business and social needs of the area. A nation of landlords and tenants creates class distinction, which is antagonistic to popular government. A homeless citizenship fosters lax morals, destroys patriotism, and undermines national greatness. Home ownership encourages truth and love and makes life well worth living. With opinions like these, it is no wonder that there was a large home ownership movement in the US post-World War I. That was the type of positivity that the public needed, a direct way to improve both their quality of life and the nation at the same time. There was still a big problem though: money. One of the most interesting articles I came across was from 1928. A housing engineer was suggesting his certified home plan to solve home buying complications. What he describes is very similar to our modern system: 20% down payment, regular monthly bills, and inclusion of taxes and insurance to simplify payments. All through one bank rather than multiple people. A novel idea, as prior to the Great Depression, most mortgages were still less than 50% of the value of the house. We see a hint of this in his plan with the mention of 2 mortgages to pay the 80% of value. Keeping the mortgage percentage low was important for lenders, as even if the borrower defaulted, the lender, usually a local bank, could simply repossess and sell to make up that loss. Odds are the house value wouldn't have dropped so far in the 19-teens and 20s as to put the mortgage underwater, to use modern terms. But in the early 1930s, house prices dropped dramatically, around 50% compared to its peak. This meant that the banks were not willing to refinance at the end of typical mortgages, knowing that the resale of the house wouldn't pay out enough. There were roughly 250,000 foreclosures a year between 1931 and 1935. Nearly 10% of all homes were in foreclosure at the worst point. On top of that, the banks went to resell these houses, adding more to the market and driving down prices even further. You can see this reflected in articles about home buying where the rhetoric shifts from "home buying makes a good citizen" to "here's a list of reasons why home buying is great for you. Please buy a home." Said list includes everything from financial benefits to play areas for children, relationships with neighbors, and even the chance to find an oil well in your own backyard. No amount of enticement would overcome the financial situation, however. Desperate to help pull Americans out of the Great Depression and help stabilize both banks and the populace, the government realized that they needed to step in. It started in 1933 with the Homeowners Loan Corporation, a part of the New Deal, which raised funds using government-backed bonds, bought defaulted mortgages, and reinstated them. They also offered fixed-rate 20-year amortizing mortgages, far more stable of an option in the long term regardless of the economy. They saved around 1 million mortgages in the short time that they existed, disbanded in 1936. They didn't go completely away, just got replaced by the Federal National Mortgage Association, better known today as Fannie Mae. It wasn't a long-term solution, but it stemmed the tide of foreclosures. Next came the Federal Housing Administration in 1934. This was a longer-term solution, just still around today, to provide mortgage insurance to investors to buy those mortgages from the government or from other institutions. Now the government, as well as smaller local banks, could more easily sell mortgages to quickly put cash back into their institution rather than waiting 20 years to recoup the money. Beyond just providing insurance, they also offered advice and guidance to those working in the mortgage field, putting out an underwriting manual in 1935 that set out a clear rating system for analyzing the risk of a borrower. Now, if you have watched my video on the history of credit cards, you'll know just how much a problem these systems had. Questions like, Prospects for the future inherently downgraded women and minorities, for example, as it was easy to claim it was, quote, harder for them to get a good job. Even location was judged based on outlines of who lived in what neighborhoods, claiming it was a social, not biological characterization. Throughout the 1920s and 30s, cartographers that focused on social maps, like Homer Hoyt, created mortgage risk maps. Hoyt started in Chicago and quickly developed a system that was nationally used. Per Hoyt's instructions, A-level neighborhoods had higher than average monthly rent, less than 1% of structures needed repair, more than 50% were owner-occupied, and all residents were white. Add in barriers like rivers to prevent slums from growing towards them, and you have an A-rated neighborhood. These maps directly informed FHA application success or failure, with some loans failing without field examinations based only on the low grade of the neighborhood per the map. Others were failed based on the buyer's incompatibility with the neighborhood. The Realtors Association actually had a code of ethics that explicitly forbade them from helping Black homeowners move into white neighborhoods between 1924 and 1950. It wasn't fully removed until 1974. Efforts to make mortgages safer, more stable, and more achievable were aimed only at white, middle-class, men-led families. The point of all of this was to solve a financial crisis, not promote homeownership. But it required the populace to become homeowners in order to work, something the government was quickly realizing might be an issue. In fact, new home construction slowed dramatically between 1930 and 1945. It wouldn't be until after the war that they realized home construction needed to be a part of the equation. The Servicemen's Readjustment Act of 1944, more often called the GI Bill, created a veterans mortgage insurance system that allowed for low down payments. This was intended to help stimulate housing construction, along with raising minimum mortgage length to 30 years. This is also the point where the American dream, as we know it, coalesced and began to include owning a home as part of our big life goals. Not just because it was generally achievable for many people, but because it was set up to be an essential part of the economy. In case you're wondering how achievable, this chart from 1943 sets up a common home price and how much income it would take. Basically, they are recommended about 2.5 times income for home value. So earning $100,000 a year today would be able to afford a $250,000 house. And the government would only continue to make things easier. In 1956, the FHA raised loan-to-value to 95% for new construction and 90% for existing homes, meaning it was even easier to save up for a down payment. All of this added up to the boom in home ownership that we are familiar with in the post-war era. Ginnie Mae split off from Fannie Mae in 1968, taking the government-backed mortgages. Fannie Mae was now private. It was a way to not only remove the debt from the government, but to make investing in mortgages and loans in general more enticing in a time where treasury bonds had better rates. So again, not specific to only the homeowner's plight, both of these changes and the addition of Freddie Mac to securitize mortgages in 1970 were to help stabilize the market. In fact, the opposition to these changes argued that Americans just needed to increase their savings, which would make more money available to the local banks. In a time of unusual inflation, this obviously didn't go over well with most. Instead, the Emergency Home Finance Act of 1970 was passed by the Senate to make the adjustments, much of which focused on encouraging and allowing the secondary market to sell off mortgages more easily. Part of this effort opened up investing in adjustable rate mortgages, which made them more widely available and incentivized to homebuyers. Especially in the 1980s, when inflation rates were all over the place, a fixed rate was extremely expensive, with interest rates hovering around 8.5% with a 30-year mortgage. Since then, as inflation stabilized more overall, The market has been about 70 to 90% fixed rate mortgages rather than variable rate. Most of our progress towards an achievable and consistent mortgage market, and therefore home buying experience, has happened in times of economic crisis. The government acknowledged that being able to afford and keep a home was essential to creating a sense of belonging in society and community. Stable living situations help to stabilize buying and thus stabilize the economy from the ground up. It would be amazing to see similar efforts being made to right today's housing crisis, as rising prices and interest rates have combined with predatory investment purchases. Some smaller areas are regulating industries like short-term rental properties, but it's not enough. In 1949, mortgage debt on a national scale was equal to 20% of total household income. As of 1979, it was 49%. By 2001, it was 73%, and hasn't changed much since then. The difference is that this time, it's not the banks that are suffering. The metrics of our nation's economy don't look that bad on a larger scale, and what does look bad is framed as people needing to work harder. Not that that's the first time we've ever heard that, but in reality, the American dream of work hard and you'll succeed and accomplish all of these great things like a house, a family, and leisure seems increasingly distant to the younger generations. It took a lot of years and a lot of effort to make the American dream exist in the first place, but expecting 1930s promises to still work almost a century later with only minor changes 50 years ago is going to take a lot more.